You're very welcome to our first edition of our Practice News webinar for 2024. Click to my next slide, and hopefully you've seen this slide and has moved in here and all of you. This is just some of our headlines for this morning. Delighted to be joined as well by Neil Morrison of McInerney Saunders. And I'm sure as many of you will be aware from media reports, McInerney Saunders has recently been taken over by Danes Group, a UK accountancy group. And we're going to talk about this. It's a growing phenomenon really in the last couple of years, the role of private equity investment in the Irish small and medium-sized practice area and accountancy area. And also just go through, we have an article coming up in our February 2024 Practice Matters, just the pros and cons on this. And Neil, having been involved in this process for the last 6 months with his own firm, will just talk through his own experiences. So great to have that. Another key team this morning is the team of sustainability and practice. Delighted to be joined by our Advocacy and Voice team, Dee Moran, Mike O'Halloran, and also by Susan Rosney. And we're going to talk about why the area of sustainability reporting and assurance is so important for the small practice as well and for your clients. I'm sure some of you may be familiar with this area. I know in speaking with practitioners, even in recent months as well, a lot of people want to update their knowledge in this area. It's going to be a key theme and of great importance to all practitioners, no matter what your size in the coming years. So we're going to give you a little taster this morning, and also a taster of what resources the Institute has, what updated resources. Susan's going to give us that as well. And if you want to learn more, we have different courses coming up in this area. Delighted as well to be joined by Damien Cooper from our actual sponsor, Accuvest. And Damien is going to give us a very quick overview of where the investment markets lie at the beginning of 2024. A staple of our Practice News webinars right from the start are our tax updates. So delighted to be joined live for our Republic of Ireland update by Gerard O'Sullivan on Leaside in Cork, and also a recording by our UK tax lead, Leon Chidoran, and that'll be at the end of the webinar. So we'll have Gerard coming up in about half an hour or so. And as Conal mentioned, I'm going to have some further homework for you with relation to practice and regulatory news, some of the key news stories that actually are going to be in the edition that's coming out next week of Practice Matters. So give you a few of those in about 10 minutes or so. So a lot of homework for you coming to read all that good guidance materials and even free webinars as well. So that's all the actual headlines. Now, with relation to who's with us this morning here, delighted to be joined. First of all, I'm going to go through our Institute team. And as I mentioned, and I think some familiar faces for you here, our Advocacy and Voice team, Dee Moran, Susan Rosney, and Michael O'Halloran are going to talk to us about all things sustainability. And with the Advocacy and Voice team, it is our actual team in the Institute that represent our members and our Institute in new initiatives, new laws, and make representations on our behalf with government departments. So that's why they play such a key role with CSRD. Of course, we're going to have Gerard and Leontia with the tax pieces, and delighted as well to be joined by our practice consultant, Maria Maloney. And Maria and Conal later on are going to have a chat with relation to the actual changing practice landscape. As I mentioned, we're going to have Neil Morrison of McInerney Saunders join us as well to share his experiences with relation to having his practice recently acquired by Danes Group, a UK accountancy group. If you're not familiar with McInerney Saunders, they're a six-partner firm, about 50 staff, based in Swords in North Dublin. Neil would have been a partner for many years. And I think many of you will know Neil. He's been with us on past webinars about even IT conferences and so on as well. So great to have Neil with us, and we'll be talking with him about 11:15 or so. And as I mentioned, we're going to have Damien, a fellow chartered accountant as well, sharing his investment expertise with Conal about 11 o'clock or so. Our attendees this morning, listen guys, it's great to have your support. We have 640 and counting booked on to the actual webinar. We have right across the island, I think even people from as far afield as Los Angeles signed in as well. Great to have you on board. As you can imagine, most people here this morning are from practice, but we have a growing cohort as well from business. And so a few more figures there for you. And that's our disclaimer. Very, very important. We include it in every one of our actual slides and webinars, particularly this morning with all that new guidance I'll be giving you in a few minutes. So guys, I am just going to give you a very quick overview of some of the key technical and other guidance updates that we have actually coming from our edition of Practice Matters that'll be released over the coming days. We'll be sending out by email campaign, I would say by next Monday or Tuesday, but you'll have some of the insights and the foreknowledge of what's coming up in it. So my first news story here relates to the updated public practice regulations. Of course, there are the rules that every institute member firm lives by. And they were last, I think, revised back about 2 years ago. And there's been obviously constant changes with relation to legislation and so on as well. And the key changes here in the public practice regulations for January 2024, these actually relate to anti-money laundering and also to the indemnity insurance requirements for authorised investment business firms in the Republic of Ireland. You'll actually see, if you download a copy of the new public practice regulations, and you can get that at the second point there. There's a good overview article of the key changes and also detailed guidance at that link as well. You'll actually see a new chapter has been added in with relation to our anti-money laundering responsibilities as an institute. So these haven't changed so much in the last year or so, but we're now for the first time explicitly pushing it into our regulations that we as an institute regulate all of our member firms from an anti-money laundering point of view. Also as well, some of you in recent weeks, and all of you will, who actually have non-institute members in your principals in your firms, will get contacted with relation to ensuring that all non-institute members who are principals in Chartered Accountants Ireland firms will actually have an AML, anti-money laundering affiliate status with the institute. This is a requirement now. So if you are the money laundering compliance officer, you may already have received communications from professional standards on this. And our professional standards team, I was just talking to Karen Flannery from that team just yesterday. And if you have any questions when you do get these communications, please do come back to them. They're trying to make this registration process as seamless as possible. It will be a requirement that all principals who are not institute members of our firms will actually have to have this status by 1 January 25. So when you do get the communications, if you have any questions, please come back to professional standards on that. If you want to learn more, again, as I said, we have that link with relation to the updated guidance and the new public practice regulations. They're the two key changing points. The investment business PII cover, we've covered that previously. There is specific increases in that requirement, and we've covered that in past practice news webinars as well. And there's more information at that link there as well. Now, of course, laws and regulations keep changing all the time, and we have a new webinar actually next Thursday covering the must-know compliance and quality management tips. So it covers everything from ISQM, a little bit of AML, the new public practice regulations, CPD requirements, and so on as well. So if you want to get the top tips and keep your practice compliant, you can click that link there and hopefully be able to join us on Thursday morning. So now my next news story is with relation to the UK Economic Crime and Corporate Transparency Act, and a very detailed and a very good brochure that has been prepared by our actual professional accounting team, Dee Morn and her team here. So as many of you may be aware, particularly if you're based in Northern Ireland, of course, we have the UK Economic Crime and Corporate Transparency Act that received royal assent on 26 October last. And this is going to be a big shake-up with relation to company filing, but also the work of Companies House in the UK. And it really is to address what would have been seen as shortcomings with relation to fraud, anti-money laundering, and so on of corporate entities in the UK, and really to give Companies House the teeth to question where it has doubts with relation to some of the companies from a money laundering point of view or fraud point of view that are on its register. It also is going to have this new act, new preventing fraud offences for large companies. It's going to have detail on that as well. And if you want to get a quick overview of what the requirements are, even if you're based in the Republic of Ireland and you have some UK clients still very relevant to you, you can actually click on that link there on the third point, and it'll give you access to the guidance brochure, very, very easy to read. And also as well on Thursday week, 22nd of February, we're going to have our guide to preparing and auditing UK financial statements. It's a webinar that's primarily for our ROI members, but it will also cover the key features of the UK Economic Crime and Corporate Transparency Act. So no matter where you're based, I think it'll be a useful webinar to go along to and get more detail on these changes, but also on any other upcoming changes for SME financial statements and auditing in the UK. Now, another piece of guidance that has been recently issued by the Institute is our Branding for SMEs guide. This was issued by our publications team back about 3 or so weeks ago. And this is a collaboration with a brand development expert, Jared Tannum of Island Bridge Brand Development. You can learn a bit more about Jared there. And over the years, he has specialized in brand development for all sizes of companies, particularly for the SME sector. And Jared here has put together this very easy to use brochure. It includes, I suppose, a lot of even examples of SMEs and how they can actually better use their brand. I'll be honest, my own experience is that brands can be misunderstood, particularly by small businesses, or totally ignored. So this really shows what powerful a tool branding can be, and how also you don't need to spend a fortune on it as well, and you can do a lot of the work yourself. I think this actual guide here, it's useful to small practices as well. If you're looking to update your own branding and get key points and tips, maybe your own website, but also a great guide to share with your clients. So hopefully you'll find that a useful guide. As well, with relation to the actual past webinars that we've actually had, we always tip off our actual spring CPD schedule with our technology conference. That was held on Friday, the 26th of January, so 2 weeks ago. Free event, so we had about 1,900 bookings, so it was a record level of interest. And this year it concentrated on, of course, AI, artificial intelligence. We had speakers from such bodies as Microsoft, from Sage, from Glanbia, covers topics such as digital transformation, employing AI, and so on as well. If you didn't actually make the event live or only made some of it, you can get a full free recording at the link there. Also, as well, and this is my final actual guide or reading for you, just last week, the CCAB, the Consultative Committee of Accountancy Bodies in the UK, issued this very useful report. The Chartered Accountants Ireland is a member, of course, as well of this body, and it really is showing the actual contribution that accountancy in the accountancy sector makes to the economies of both the Republic of Ireland and the United Kingdom. Some quick figures here. It looked at the year 2022 and that there are actually over 911,000 jobs supported across the UK and Ireland by the accountancy sector, and also 114 actual billion in actual contribution to the economy, 114 billion euros. So massive figures. If you want to learn some more, you can download the actual guide there. And Garode, hopefully you're here and can hear us and see us, and that we can hear you and see you.
Hi, Jeremy. Yeah, I can hear you and see you. Hopefully, you can see me and hear me as well.
We can indeed. We can indeed. It's great to have you. Great to have you with us again. As I say to you, a familiar face here on Practice News, and I know that you to be constantly as well dealing with members on queries and on different things. And it's been a busy start, I know, to the new year. The enhanced reporting requirements, I'm sure, is definitely exercising members and their clients' needs, but a lot of other things on the go by you as well.
Yeah, it's been a busy start to the year, including my own opportunity to vote yes. Also, I should put my own personal and professional decision has been also to vote yes. As someone who's gone through the FEs, it's been a kind of a good, clear decision for me. I think the idea, as you see here, we're doing quite a lot of advocacy on behalf of the accountancy profession. So the idea that we could do this as the largest body is something that excites me on the advocacy side of things for sure. So with that in mind, you see right at the outset, I've put in some of our recent consultation responses here. These are some important, two of these are particularly important in that they're hopefully imminent that's the share-based remuneration and the dividend participation exemption consultations. So the dividend participation exemption is another, I suppose, word for what we've been lobbying on for a while on territoriality, so a territorial system of taxation. And this is where I suppose there has been quite a lot of updates to the tax code in the last 10 years. Certainly since I've been a tax practitioner, this whole concept of anti-avoidance has been copper fastened into everything we do as tax advisors. And the next step from that is this thing called the dividend participation exemption, which would say at the moment, if you're an Irish company and you're investing overseas and you're doing business overseas and you're paying tax overseas, in order where you're repatriating profits by way of dividend, there's quite lengthy calculations that need to be done to get to a net of essentially a net zero tax position. Typically our tax rate on trading profits on dividends derived from trading profits is 12.5% as well, and typically overseas tax rates are higher than that, and that's sort of well documented by everyone at this stage, and well known by most people even. So I suppose in terms of efficiency and just the timing of it, we've been saying the time is now right to move to a full exemption for foreign source dividends. The tax base is now protected by this robust anti-avoidance we have in place, various measures that have come down from EU. And indeed, Ireland's interpretation of a lot of these measures has actually gone over and above what perhaps the EU have required. So our tax base is very well protected now. And that's, I suppose, what's come out of our consultation with members. The consultation on share-based remuneration is also obviously a very important one. This is a key lever for attracting talent, and it's not just in the accounting world that we're having issues with talent. It's right across the board. I was even speaking to a friend recently who's working in Europe in the energy policy and energy advocacy space, and he's blue in the face trying to get someone in to kind of help him out with what he's doing, and he's doing very exciting work. But again, I just said, look, join the club. We're all trying to get good people. So for now, you're stuck with me here, as they say. But genuinely, I suppose share-based remuneration is a key lever for attracting talent, and in this country, I suppose it's fine for the bigger companies, the PLCs, the share-based remuneration it works well enough there that it's useful to employees and it does attract the talent. But I suppose when you drill down into SMEs and startups, I suppose one of the key points we're making is that you need to have, I suppose, a specific regime that will look at the needs of SMEs, particularly cash flow being the big concern for SMEs and startups. And then for private companies, there's always issues around valuation. So looking for certain safe harbors when it comes to valuation. So I've hyperlinked the response there. If you're working in this space, I'd encourage you, if you're in the international tax space and if you're in the employment tax space, I'd encourage you to read our consultations there and just even the exec summaries, just to get a sense of the points. And if you have any further views on it, we always like to hear from you. tax@charteredaccountants.ie, or as my own Garrow.O'Sullivan@charteredaccountants.ie. The public consultation on VAT. So this is a revenue-driven consultation, and it's just to get the kickoff for the VAT modernization. We're looking, I think it's a 2026 and beyond for, I suppose, really getting a VAT modernization regime going. And I suppose the sense at the moment is that would start more at business to government level, and that there'd be a phased implementation. So I suppose that's the key point here. And I suppose we just made the point that there needs to be a lot of engagement with stakeholders over the next couple of years, and this will take place in particular via the Tax Administration Liaison Committee, the Indirect Tax Subcommittee that sits under that umbrella. So that's what's going on the consultation piece. This consultation, we respond to consultations as a CCABI, so that's the Consultative Committee of Accountancy Bodies Ireland, and that does include, as it happens, CPA members, and they do provide invaluable technical and high quality technical input into these consultations. And I suppose that's the next point here, which I know will be of I'm sure is an emotive one actually for a lot of our members, because it has been an emotive one for us on the advocacy front for the last year, and that's the enhanced reporting requirement. And I know there was just seen some of the questions come in. One of them was how will a larger body give us a stronger voice in pushing back on these measures, and I certainly think so. But on this as well, on our subgroup that met and that has been meeting, one of our most valuable representatives, and that is one of our CPA members, Carla Manning, and she has provided again invaluable technical and practical input as we go back to revenue on this. The update from the most recent meeting I just want to share is around the first on the service for compliance approach. So you may have heard that revenue have agreed to this service for compliance approach, and I suppose that's going to run from January, so from the start of last month, from returns due from January up to the end of June. What revenue have said at the meeting is that it's not intended to go back and revisit mistakes that were made in the period. Revenue, I suppose, understand that some employers are more prepared than others and have software available. At the moment, what revenue are saying to us is that they just want to encourage employers and agents to familiarize themselves with the reporting system and report any issues as they arise. So again, if you are encountering difficulties with the filing, again, please do email us at taxcharteredaccountants.ie. Now, I suppose through the subgroup membership, our representatives there are pretty much picking up all the issues because they're dealing with a huge cross section of members between those working in small practice and picking up what smaller businesses are encountering, right up to our big four and big firm membership, where we are getting, I suppose, what the larger entities are encountering as they get up to speed with this reporting requirement. So the service for compliance approach does require that you submit returns. So look, we're all aware it's a double-edged sword. The question has come in, if I submit information and it's maybe not, there are slight mistakes, does that trigger a warning sign for revenue? And look, tax risk is the name of the game for us in tax. Certainly since I've been working in tax, the idea of great big tax schemes certainly aren't there anymore. It's how can we minimize tax risk, because it's ultimately about good compliance these days, and this is a key risk factor. So I am aware of that. I suppose the query was raised about the likelihood of an employer being selected for intervention as a result of non-filing. I suppose revenue's line on this is, as always, that there are many reasons why a taxpayer is selected. It's multifactorial. And there are also, they'll accept that there are reasons why a person may not have filed, or why filing or non-filing isn't, so there are reasons why people may not file, and therefore they are informing us at the moment that filing or non-filing isn't necessarily going to lead to a greater likelihood of intervention. So it does remain to be seen on that. I suppose, as always, risk assessment and selection for compliance on EOR will be in line with the existing compliance framework. But I suppose, as we said to you, unfortunately, since it has come in, that you do need to engage with this as soon as possible, if not already. I suppose it's not to take the service for compliance approach as meaning I don't need to do anything. Quite the opposite. You do need to be engaging. It's just sort of, I suppose, at least if there are mistakes, it won't lead to penalties. Now, I suppose what we're reporting here are non-taxable benefits. The key issue here is not that these need to be reported. The records need to be kept always of non-reportable, non-taxable benefits in order to claim them. That's a requirement for a lot of these. Anyway, it's the real-time reporting requirement we continue to raise as the key issue with this requirement. If this was a quarterly or a biannual type requirement, fine, that would make sense. But look, if for you and for your business that you work for, this is obviously the real-time reporting requirement is the real encumbrance here and the real challenge. So anyway, that's the latest update from the subgroup. I suppose we've kind of spoken about the technically what's required, and there is useful information obviously on revenue, and they are continuing to run webinars, so you can sign up for them as well by going on to revenue.ie and just going on to the enhanced reporting section. They have further details there. So I also want to mention the recent decision in the Revenue Commissioner, the Carson. So this is the Domino's Pizza case you may or may not have heard about. And this is a significant judgment in the area of employment tax law. So this looks at the fundamental issue of when is a worker an employee and when is a worker an independent contractor. Carson, as it says, they're trading as Domino's Pizza. So in this case, this Domino's restaurant were hiring drivers, and in their view, these drivers were hired under a contract for services, i.e., independent contractors. And in Revenue's view, these drivers were employees, i.e. hired under a contract of service. So it took me a while to always get clear on the of service versus the for services, but there you have it now, hopefully. If you're working in the area, if you're working in business yourself, and whether you're tax specific or not, but if you're in the business of hiring people and part of your business involves determining is this person an employee or a contractor, the Supreme Court judgment is excellent. But more importantly, because it's a Supreme Court judgment, it's of highly valuable precedential. It's got high precedential value. And we have a case note going out in this month's Tax Point magazine, which you can subscribe to if you wish. But in that, I suppose I've traced the decisions from the High Court into the Court of Appeal and into the Supreme Court, and I suppose the confusion happened here at Court of Appeal, where it overturned a High Court decision, which the High Court decision upheld the Tax Appeals Commission, which sided with Revenue that yes, these drivers are in fact employees, as opposed to independent contractors. There was a contract in place between Carson and the drivers, but I suppose one interesting point that they looked at here was this asymmetry of bargaining power, and sort of that there was this contract which said we are independent contractors, and they duly signed it, but the quality actually of that agreement was more, wasn't important, we'd say. What was really important was the overall fact pattern, which really suggested that the balance of power here lay much more toward Carson as the employer, and that the things like substitution, the fact that the drivers couldn't meaningfully substitute for another driver, they could essentially refuse work, but that's, we can all refuse work, even as employees. I mean, how long you can refuse it for, that's obviously a question for you. But the other idea was how integrated are these drivers into the business of Carson. So I suppose what was interesting in the Supreme Court judgment, you can't give a sort of a clear-cut test here. There isn't a decision matrix that you can sort of create to say definitely employee, definitely contractor. You really do have to look at the circumstances of the particular relationship, and that's, the idea of this mutuality of obligation. This is kind of an old term that's been thrown around the courts. They said, look, they didn't. The Supreme Court sort of didn't look at that, not in huge depth. They looked at it much more on the whole. They said, just receiving work for pay sort of creates some level of obligation between two people. Look, if you pay me to do something, I'm obliged to do some work for you, in normal course of events. So that case anyway, it is worth to read. In particular, it's lengthy, but when you get down to the decision, they set out the key tests, some key tests to look at there, and I think it is worth your time, particularly if you're working in tax law yourself and you're advising clients daily. A very important judgment to read. If you're working at a kind of an executive level or a leadership level in your company, and you're involved in hiring people, again, I'd really encourage you to read this judgment. Sets out the precedent clearly and establishes a very clear Irish position in this area. So just want to mention the talc business simplification subgroup. So this was mentioned in Minister McGrath's speech, and the group has since met twice now. There was an initial kick-off meeting just between Revenue and the representative bodies, and there's since been a meeting between Revenue now and the wider representatives put forward by the bodies. The aim of this group is administration. So it's not going to, I suppose, because it's a revenue-led group, they don't have the power to look at policy. That sits squarely within the Department of Finance always. But this group will look at administration, and particularly things like EIS, and how these reliefs can be made, I suppose, at least more straightforward to claim. What are some of the key barriers when we're, I suppose, applying the tax code? What do we encounter on a practical basis? So the aim of this group is to meet monthly up to June, and a report will be prepared for the attention of Revenue, but obviously that report can be shared with the main talc body, and therefore it will be part of the public record as well, and obviously will be shared with Finance also. And it will form hopefully a good part of our advocacy work as we move into budget 2025 later in the year. Lastly, I just want to mention the debt warehousing scheme. So, as you will hopefully have heard, if not already, that the minister has announced the extension, the indefinite extension of the debt warehousing scheme, and the reduction of the interest rate on warehouse debt to 0%. So, cognizant that some taxpayers who have had entered the warehouse and who since repaid their debt will have potentially paid interest of some amount on their warehouse debt. They will be entitled to a refund of any interest paid on warehouse debt, and obviously going forward, businesses in the warehouse won't be subject to interest on that debt. The key point for you as a business or for anyone advising clients in this regard is that you must engage with revenue before the 1st of May to either repay the debt or to agree some phased payment arrangement. Now, revenue have stated at the various TALC groups that they are open to we'd say, bespoke PPAs. So they will look at it on a case by case basis, and they will work with businesses here. They've been given the imprimatur from the minister himself to do so. And to be fair to revenue, they have come to us, very positively saying, look, just come, engage with us, and we will work out a plan. As I say, you need to have engaged with revenue by the 1st of May. So if you haven't already, I'd encourage you to engage now. Sooner the better, always with these things. But I suppose this is a measure which has been welcomed with business. I've been chatting with members around the country recently on this, and it is seen as a positive step. There are some initial concerns about it in terms of tax equity and things like this, but I think on an overall basis, this is good for the exchequer in that, instead of businesses encountering difficulties or obviously the key cash flow issues, it'll just ensure that businesses can remain viable and therefore continue to contribute to the overall tax take. So look, that's this season's tax update. I hope some of that was useful to you. As always, you have our details there, how to contact us if there's any specific queries. But yeah, I suppose all the best for the few months ahead now as you're coming to terms with ERR and the various things.
Yeah, well, thanks again for that very detailed update. Yeah, definitely has been a busy few weeks for your team, particularly with the consultations and so on. As ever, there's a few questions come in for you. You can guess with relation to EOR, of course, debt warehousing and so on, those recent changes. So if hopefully you can stick around for the next half an hour or so, we might have you back on again towards the end if there's any further themes or thoughts that you'd have. Would that be okay for you, Garrod?
Yeah, that sounds good, Jeremy.
Brilliant. Hey, look, thanks again. Well, listen, the show moves on, and we're delighted again to be joined by Damien Cooper from Accuvest. And I know that Conal, yourself and Damien are going to have a quick chat with relation to the current investment market.
We are indeed. Damien, it's great to have you back on again. And I'm just checking to see, can we hear you there, Damien?
Good to see you, Colin. Thanks very much. Good to be here. Apologies, I turned on the video but forgot to turn on the microphone. So
that's all good. That's all good. So look, Damien, first, and we're very, very thankful to have Accuvest sponsorship. Again, Jeremy, if you just give us the slide there showing what Accuvest do. If you're still there, Jeremy.
Well, indeed, yeah. Hopefully you can. Am I having? Can you see it now?
Absolutely.
Brilliant. I'm having a sticky mouse here.
Okay. Very good. Well, listen, Damien. Look, I mean, it's obviously what you do is to advise. To advise businesses and individuals about investments, and we were having a chat before this. What are we talking about? It was obviously a good sort of end of the year, but once again, looking out into 2024, there seems to be a fair degree of uncertainty. Would that be fair?
Yeah, it is fair, and I suppose great to be here, and we're delighted to be able to work with the institute and with members, I suppose, and their clients, to help them, I suppose, navigate the tricky waters of investment markets and of financial products and planning for investments. I suppose we've had a quick chat before about things that are the challenges that we're all facing. And one of the things that resonated when I was reflecting on that was that, you reflected back that we were talking about the economy and the employment markets being tight, and how that's creating issues for professionals, and presumably their clients, who are can't hire staff, and everyone's busy. I suppose what that brought home to me again on reflection was, what's important to remember, I suppose, is that time and resources, like time is probably the most valuable and precious commodity that all of us have, especially, I suppose, if you're running a busy practice, you're running a busy business, you have other things going on in your life as well. Finances and assets, like, they need to be managed. But I think what we all need to, I suppose, take more and get more appreciation from is we can't all, we can all do anything we like. If you're educated and you're intelligent and you're smart, you can train yourself to do most things, and you can apply yourself to most things. But what we all need to remember is that while I can do anything in my life, potentially, if I have confidence in my abilities and stuff like that, I can't do everything that I'd like to do. And so we need to pick where we're allocating our time and resources and our expertise. And so what we need to think about is, do I have the time to manage my finance and investments? Am I going to be an investment expert? And if not, do I believe it needs to be managed, or to get better outcomes from managing? And then, then you need to find someone that you trust and find someone who will do it for you. And I suppose from our perspective, I'll give a quick update on markets, and so that's important, and it's always nice to get an update on that and insights into what that means. We're advising clients for their investment portfolios, but the biggest thing that we do for clients, and for accountants and their clients, I suppose, the biggest thing to remember is, while thinking about the way your money is invested is really important, and listening to markets is really important, and thinking about, what does that mean for the returns I've got? Were they okay? What is going to happen next? Some of that is guessing, and it's informed guessing, and people like me who spend all their time reading markets and researching markets are informed to be able to give you insight into that. But the most important way we help clients is by developing a plan. And that's really taking the time to think about, what am I trying to achieve?
Yeah.
And what time, money, resources do I have in order to get there? And then, do I have an overall framework within which then I can place these investments and think about them? Because if I don't have that, if I do have that, then it allows me to think about, okay, I have cash here. It's on deposit. I feel I should be making it work harder. And you kind of go, that's fine. I feel I need an answer. But if I have an overall framework, I kind of go, well, actually, sometimes that's the right thing for that to be. So sometimes inaction is the right action. But you need to have the framework, the confidence to have had the time to do that, to give you the confidence to be able to say, yes, I'm okay. And no, I don't need to worry about what I heard on the news, or this new product, or this structured product that sounds fantastic, it's giving me upside and downside protection and all that kind of great stuff. You have a context for it, and that's what's really valuable, and that's what you get from having taking the time. And I suppose at the moment, I'll talk about uncertainty in markets. At the moment, thankfully, we're in a better place than we were this time last year. We've had a good year in investment markets. Equities and bonds have done well. We look forward from here. We've got reasonable level of interest rates at the moment. The interest rates are high, therefore my cash returns should be getting 3-4%. I should be able to get on cash on defensive assets. I don't have a burning need now to start deriving stuff into money. I can get a reasonable return from having defensive assets at the moment. So it's good time to think about, what am I trying to achieve? How am I doing on my overall plan? And how, what does my plan look like? How do I develop that? How do I have context? And so that's just an important reminder. It's in the society we live in, where we're increasingly rewarded with instant answers, instant feedback, so it's, but if you think about from a financial perspective, an analogy that I use sometimes is like, if you think about someone that's looking for an instant answer, it's like I'm really hungry, I'm in the middle of a high street and I've got money in my pocket. Am I going to go to the newsagent and buy something that's going to give me an instant sugar hit? Probably, if I'm really hungry. Is that what I should be doing? Or, should I have a sugar hit in my pocket if I want to be doing? I'm probably overpaying if I'm buying in a newsagent. I probably should be, buying these things in a planned way, as part of my overall supermarket shop on a weekly basis. And so it's thinking about having a plan just informs me. It means you're less likely, nobody knows the future, but having a plan means you're less likely to be panicked into a rush decision, into a misstep, into being sold something. So that's just the context. And so I suppose maybe I'll quickly, I'm conscious that we don't have a lot of time, but I just thought that's something that I think is worth remembering. It's the background. It's sort of, that's the framework. Like everything else is kind of, it's the foundations. And so everything sits on the foundations, and looking at the right investments and stuff like that, it's all fine, well and good. But if you haven't got decent foundations, you're likely to get blown over in the wind. And so especially now where, we're looking at, if I look at what's happening in markets, like where we are now, we've got interest rates of, nearly 4%. They are high. There is, thankfully, from here, we're looking at, I suppose, at the prospect of them starting to come down, probably, late spring, early summer, when they start to come down, and potentially big cuts forecasted into the markets this year. So markets are pricing in 1%, 1.5% cuts in 2024. Now, that's a good thing for me as a consumer, because I don't have to pay as much on my borrowings. As a saver, it's not quite so good, because it means that my cash will earn less in the future. If we look at, one of the reasons for those cuts is that inflation has come under control, and so inflation is down, and that's great. It's still high, but it's not out of control anymore. So my cost base isn't going to erode, and therefore that's a good thing from a societal perspective. If we look at the employment markets are still very strong. Consumer confidence is still very strong. Economic growth, we were looking at potentially, economic growth, we were looking at recession. It looks like that might be avoided, certainly in the US. Growth has been weak in China, but it looks like the Chinese authorities are starting to do something about that, which is good. It'll be negative in Europe. Hopefully that will be given a push start by interest rate cuts, or the prospect of those cuts. And so we might avoid a really big recession. If you look at the markets there, we're looking at a positive outlook for equities, because corporate profitability is still very high, because consumers are still out spending. So corporates have more managed to sort of get through what we feared without too much of a downside. Consumers seem to have held up relatively well, which is, again, very good from a consumer perspective. If you look at then the flip side of that, is that interest rate cuts are coming through because economic growth is coming through. So there's a contradictory message there. Equity markets are saying, yes, we're going to do well because corporate profitability is going to stay well. Consumers are going to keep spending. Bond markets are saying, interest rates are going to get cut because economic growth needs a stimulus. This level of interest rate can't be sustained in the economy. The economy will go into recession if we start doing that. So obviously the net message is positive, but it's just about positive. And so it's positive, and it's more positive than it would have been this time last year, which is great. But it's uncertain. And then we've got a massively uncertain geopolitical backdrop as well. So, if you look at obviously the ongoing conflicts that we have in the world, which are very unfortunate, but still continuing. And then with half the world's population voting this year, with the outcomes very uncertain in many cases. Now, is that likely to have a massive impact on markets? I don't think it necessarily is. I don't think it's necessarily going to have a massive impact on economic outlook. But I think from a geopolitical perspective, it is likely to have an outcome. And so markets will react to that with probably increased volatility, increased uncertainty. So what we are saying to clients right now is that this is not a market for short-termism. So if you only have a short-term horizon, you really don't want to be invested in the markets at the moment. You can get very good returns on your cash. So cash, money market funds, for example, are yielding 3.9% at the moment. So you should be able to get somewhere north of 3.5% for cash if you're invested in the right stuff. Bond yields are, somewhere between 2 and 5, depending on the level of risk you take. So you don't need to be rushing into growth markets at the moment. You can say you get a reasonable amount of return from having defensive assets. So take the time, develop a plan, and then average into markets as is appropriate. So I'm probably out of time, Colin.
Some super insights there, Damien, from the top, the overall just call to reflect, but equally those insights. I mean, it seems to me that, cash is good at the moment, but can't last. That's good and bad, because that means that interest rates coming down. Some very good reflections there on what's happening in the world. Always good to hear, Damien. Look forward to having this discussion again next time. We're going to give you a bit more time next time, but the asset we don't have at the moment is time.
Yeah,
So,
and people reach out. If there's any questions, please feel free. And if anyone, we have a longer session the next time. So if people want anything that they particularly like addressed, maybe send through a message before in advance, and we'll make sure that we cover it off in our longer session when we get there. Thanks very much, guys, and delighted to help.
great to have you on board, Damien.
Cheers.
Great talking. Look after yourself.
Thanks, Conal. Thanks, Damien. Some great insights there indeed. And yes, Damien will be back with us on the 12th of April, our next edition of Practice News, for a longer session. So looking forward to that. Now, moving on, our next segment here looks at sustainability. And the last year or two, particularly 2023, a lot of change in sustainability. CSRD is definitely one thing that springs to mind, ESRSs. But 24 is going to be an even more important year, with CSRD formally going into Irish law. Obviously, movements in international requirements as well around reporting. And also we have assurance on the horizon in this area as well. I'm delighted to be joined by some familiar faces, I'm sure, here to the audience. Dee Moran, our professional accountancy leader, Mike O'Halloran, our technical manager, and Susan Rosney, our sustainability officer. And Dee, Mike, and Susan are going to give us a little bit of background as to what has happened, the key things in the last year or so with relation to sustainability, and also trends and areas to look at into the future, and particularly from a small practice point of view with relation to reporting and assurance, and what you need to be thinking of, because it will impact all practices and it will impact all sizes of clients, even SMEs as well. So to begin, I'm delighted to actually be joined by Susan. And I know, Susan, you're hopefully there and can hear us.
I am indeed. Can you hear and see me?
I can indeed. And I know, Susan, we're going to kick off. You're just going to, I suppose, set the scene. And it's great to have you back on again. I know you're a veteran of Practice News. It's 2 or 3 times. I think we always do this at the start of the year. And it's a one for the future, for sure. But I think the future is actually landed and with us now. And 23 has been a big year, and 24 as well. So I think you're going to begin and tell us about, some of the things and developments in the last year that you want to talk to us about in the sustainability area.
I am indeed, Jeremy. Thank you very much. And actually, I will move to the next slide, because a lot of the developments in 2023, we could probably just roll into 2024, because as you say, the future is with us. And I think in the interest of time as well, I have my timer here to make sure that I definitely stay on track. But it was very interesting actually just to hear Damien talk about some of the matters that actually I was about to mention as well. So I'm going to go over those. I'll gloss over those very quickly. He rightly mentioned that half of the world's population this year is going to be going to the polls. And while you mightn't see the immediate change for businesses, it's certainly a trend to watch out for, because it will have an impact as it trickles down through the various supply chains, but also in the form of policy updates. We also have, you mentioned the geopolitical uncertainty, and we certainly saw that last year. And this year with 2024, the World Economic Forum has predicted of its top 3 risks. We have geopolitical, social polarization, climate change, and also misinformation and disinformation. So those will have an impact in policy formation globally. There will be an uptick again this year, as there was last year, in transition finance. And so this is finance that is there to support the transition to what's called the climate resilient, climate neutral, and climate positive society and economy. And you'll see those in the form of the climate action plans that our government is issuing, but also in other policies such as the most recently released National Biodiversity Action Plan, which now has legislative underpinning for the first time. And also we have seen a consultation just being issued on the National Adaptation Framework, which itself will apply to businesses and how they adapt to the extreme weather events that climate change is bringing. I will not be talking about preparing for the CSRD and the CS-DDD, as my colleagues Mike and Dee will be talking about that. And they'll also mention something that we touched on a bit during last year, which was the greater focus on Scope 3. And for people wanting to find more information on how small businesses and their advisors will be impacted by the requirements of larger companies on smaller companies to update their environmental and social policies. You can look back on some of the webinars that you'll find on the Sustainability Hub. Only last November, Dee and several other of our Chartered Accountant members spoke at Climate Finance Week about this, about you're in scope because they're in scope, and it's definitely one to look out for. Something you may note as well this year is a greater focus on what's called greenwashing, which is where companies will make a claim to do something that they can't necessarily back up. But actually the focus has now almost become so great that other companies are engaging in what's called green hushing, which is making changes but not necessarily advertising those changes for fear of a backlash against them. So they see this as a kind of a public relations risk, that they don't necessarily want to talk about the good work that they're doing. Sorry. Another uptick you may see in the paper certainly is in litigation. So there's currently 2,300 cases globally where either citizens are taking governments to court for climate inaction and the consequences, sometimes devastating consequences for them, but also companies being taken to court by either climate activists or others for maybe pollution activities or other and often inaction themselves on changing. For people, the jobs and skills is still an item of relevance in sustainability, particularly around the area of ESG reporting and upskilling in both the financial services, but also the industries around, say, renewable energy and the circular economy. And on the circular economy front, many of you may see the new machines for things like the deposit return scheme, where you can take, where you can say hand back bottles and have more, basically there's more focus now on renewables, like renewable energy, but also renewable materials, which has an impact again on supply chains. And there's a greater focus on assurance, which my colleagues will talk about, but also you'll see a greater focus on data, and even in some instances, people being required, maybe at the larger end of things, for geospatial data. So to be able to prove that when they claim that their cocoa, for instance, is being harvested from non-deforestation prone areas, that they can back this up with data, drone data in particular, to show that this is indeed the case. So greater scrutiny on everything that is being disclosed. And there's also, say, nature and biodiversity and businesses. Those are really coming together. We saw that last year. We'll see it again this year. And you'll see in a bulletin that I've just issuing today on, say, the Business for Biodiversity platform in Ireland is looking for companies to take part in that. You'll see it rising up through the agenda. And finally, for this year, and again for the next few years as well, we're seeing record-breaking climate events every month. Seems to be, this is the hottest it's been on record this month, like January. Copernicus in Europe came out this year to say again, hottest month this year, it'll continue to be the hottest months and having these record breakers. However, for businesses, this obviously has implications for, in Ireland, for the health and wellness of employees, business interruption, supply chain interruption, and again, there'll be more kind of adaptation policies that the government will be introducing to take account of these changes. And you would have seen, obviously, the floods in Cork this year would have been a kind of a prime example of one of those record-breaking climate events. And Jeremy, I may go on to my next slide, and just to I won't go into these in too much detail at all, but just to point out some salient items. There's 2 diplomas I'm going to launch in March this year on sustainability reporting and also sustainability assurance and reporting. You will find out more about that at a open day, kind of a virtual open day next week on the 14th of February, and look out for details of that in the e-news and in various other bulletins. And there's loads of resources throughout the Institute's team that they put up on the websites about sustainability in all its kind of forms, either through publications or events. But maybe the best way to keep an eye out for those is in e-news, where you'll see the technical roundup that the technical team produce, my own sustainability bulletin. You'll also see content in tax news and in other networks. And the final thing I'd say, if you wouldn't mind going to the next slide, Jeremy, and this is my last slide. Actually, no, this is my second last slide. You can find out about the institutes, how we as a small business, we're an SME, how we're managing our own climate impact, our own social impact. And the image on the left there is some information about how we work with local companies to create more biodiversity friendly and nature positive projects. And this is going to be my last slide at breakneck speed. That is something to draw your attention to. I think Dee will mention it as well. There's a new network for chartered accountants are working in ESG and sustainability. You'll see it on the Sustainability Hub. There's an email address there for you to email. It meets once a month. We had our first in-person meeting there last month, but mostly it's online, virtual, break into rooms, and people can discuss best practices and things that they're interested in finding out more of. So you're welcome to join that. And the image on the bottom of that page there is a link for the Sustainability Centre. Okay, I'm going to hand over now to my colleagues Dee and Mike, and thank you very much for your attention.
Thank you very much, Susan. That was great. And I would actually say your ESG network group, I attended it for the first time back in January. There's people from larger consultancies, from business, from industry, public sector, but also from small practice. So it's a great group to have that networking. And if you haven't seen the sustainability bulletin, both on LinkedIn and on e-news on a Friday, so much information there. Without further ado, I'm going to delighted to be joined as well by Dee and Mike. And I know, Susan, you're staying with us. There may be questions coming in, so you'll be happy to keep an eye there on the Q&A and different things. And don't be shy if you do have any questions for Susan, for Dee, or for Mike as well. Ask here, or perhaps contact them as well, or get involved in the network group. Dee, Mike, great to have you along this morning. Hopefully you're there and can hear and see us as well.
Yeah, absolutely. Thank you very much. So we just thought we'd just give you a flavour of what is happening in the world of sustainability reporting at the moment. It might be just worth giving a very brief overview of the CSRD. So this was approved by the EU Council in late 22, and it's commencing for the largest of companies. It did commence on 1 Jan 24, and we'll see that the timelines. And it is intended to replace the NFRD, and it's really going to widen the scope of companies who will be looking at this. NFRD is about 11,000, and we expect that this will be applicable to about 50,000 companies in Europe. The scope of reporting it's much more forward-looking, and it includes qualitative as well as quantitative data, and it will be done under the EU taxonomy regulation. What the CSRD does introduce is the concept of double materiality, and Mike will review this in further detail. And the framework that's used are the European Sustainability Reporting Standards, and that's what companies will follow to comply with the CSRD. There are 12 of these in total. There's 2 cross-cutting ones, and they kind of cover the general principles and the disclosure requirements. Then there's 5 environmental, 4 social, and there's 1 on governance. Then just looking on the other side, who is in scope, you can see the 4 there. So those companies at the moment are the large PIEs, public interest entities with greater than 500 employees. That's for this year. Next year, then it's other large companies, and I think this will bring a lot more Irish companies into it. Just on this one, it will be applicable to companies that meet 2 of the following 3 criteria. So 250 plus employees, 40 million in turnover, and 20 million in assets. So just to say, for a lot of you, maybe that isn't that big actually. And also just to say that we anticipate that the revised company limits will come into force when the CSRD is transposed. So these will increase to 50 million in turnover and 25 million in assets. Then 26 is the listed SMEs, and then 28 is the non-EU parent. It'll also bring in mandatory assurance. Initially, this will be limited and reasonable potentially in 2028. So this obviously will bring up requirements around additional training and education, and practitioners will have to qualify to carry out sustainability assurance. So this has all been looked at the moment. There will be a registration process for those who are existing RIs, so that they can be grandfathered in. There's a lot of information on this on the professional standards part of our website, and actually we might just put some of those links into the chat function. And the CSRD also has the option for separate audit firms to complete both the sustainability and the financial audit. Very briefly then, the reporting format, now it will have to be clearly identified within the management or director's report as a separate section and not as a separate report, and it will be required in XHTML format so that it can be electronically read and tagged. So that's really quick whistle stop tour through the CSRD, and again we have lots of links at the end which hopefully will help you to various resources. If you can just put up the next slide, please. So just in terms of 2024, I mean, I think this is just a really hectic year for all things sustainability reporting. As I've already said, the largest companies are gathering information. They're going to have to report on their 2024 data. I think a lot have completed a dry run on 2022 data just to see how ready they were, and they are working on processing data to ensure that they are ready. These companies are also going to be engaging with their value chain, requesting information from them, and Mike will cover that later. EFRAG are doing a huge amount of work. They drew up the European Sustainability Reporting Standard, so they are busy producing implementation guidance to assist preparers, and they have lots of information and guidance on their website. They also have a Q&A section for you to submit questions, and they've recently produced a summary and analysis of those. Again, we have a link to that on our website. This year we'll also see the issuing of ISSA 5000. So this is the assurance standard for sustainability reporting. The Institute recently responded to a consultation on this, and the standard will be published before the end of the year. It's not expected in the short term, at least, that the EU will produce their own auditing standards, and therefore it is likely that that this ISSA 5000 will be adopted in some form in Ireland. Also, the CPD, there's many members looking at getting up to date on this. Susan has already put up the resources that are available, and we do have a number of webinars and guidance on our website. And as I've already said, we are looking to register auditors as sustainability assurers, so we will put up that. Just on the CSDD, I'm not going to say a lot about it, except that it is a major piece of EU legislation that is coming in, and it's really, I suppose, looking at companies to conduct both environmental and human rights due diligence across their operations, subsidiaries and supply chains. There was provisional agreement reached on this in December last, but there is a vote today actually on the final text. There is a bit of unhappiness in some countries on this, so I think it'll be interesting to see what happens at the vote today. There will be further details on our website on this as it is approved and adopted, but it is not due to apply to the largest companies until 1 Jan 2026. And we are also waiting on the CSRD to be transposed into Irish law, and it must be transposed by July of this year. We are expecting and hoping that that will be in a little bit sooner, and alongside that, that the amendments in company size will be regulated with that also. There were 16 options that member states could take an when we've a fair idea, the transposition will confirm what options Ireland will actually take. And just in terms of NI and the UK, it's expected that the UK government are going to consult on endorsing the ISSB standards, IFRS S1 and S2, and that they will be endorsed in the UK sometime after that consultation. So again, we will keep you up to date on that. And very briefly, just on the last slide, so looking forward to 2025, you'll see the first reporters due to issue reports under the CSRD, and we'll see limited assurance from some of the assurance providers, and then that cohort of companies in the bracket that we talked about earlier, they will begin to come in scope. And I think this will result in an awful lot of other smaller companies being impacted and brought into here because they will be getting questions on their value chain. So, you know, I think very important, this cohort really need to be preparing now and get their data ready and their processes in place. And 2026 and beyond, well, listed SMEs will come in from about 2026, and in time expected that the move will be to reasonable assurance, which at the moment we expect to be in 2028. So to go through a couple of more of those matters in more detail, I'm going to pass over to Mike. Thank you.
That's great. Thanks very much for that, Dee. Yeah, so as Dee mentioned, the purpose of my piece here is just to give a brief introduction into, I guess, some of the concepts that sit within the European Sustainability Reporting Standards. I'm not going to go into them in a lot of detail today, but maybe in a session at a later date we might cover them in a bit more depth. So the first area I'm going to look at is double materiality, and double materiality is a fundamental principle of the European Sustainability Reporting Standards, because when a company is reporting under the ESRS standards, it'll need to consider the specific impacts, risks, and opportunities that need to be reported on in its sustainability statement. And the assessment of what's required to be reported is done via a double materiality assessment. So as a name like double materiality might allude to, it's materiality but viewed through two perspectives. So when an entity carries out a double materiality assessment, it'll look at its sustainability footprint through two perspectives, with those perspectives being financial materiality and impact materiality. So financial materiality is possibly akin to the methods in which we currently view materiality in our non-sustainability day-to-day roles. You know, financial materiality considers the financial risks and opportunities that sustainability factors might have on the business. So what an entity would be looking for here are things that trigger or might be reasonably expected to trigger material financial effects on a company. So I guess an example here might be energy. So if you have a company that consumes a lot of energy in its production process, well, the risk that energy prices might increase could present, you know, could be material from a financial perspective for those reasons. Similarly, maybe a company with poor health and safety practices might see, you know, potential financial risks as a result of various litigations and things that having bad health and safety practices might bring. So that's financial materiality, and then impact materiality is quite a new concept, I guess. That then asks the company to consider the impacts that it has on environmental, social, and governance, on ESG factors, and then to report on this. So in doing that, the entity will need to just consider its stakeholders and how they're impacted by their actions. Now, a company's or an entity's stakeholder base, you know, will be quite wide. And if you were to imagine a company considering, well, who are our stakeholders here? You know, they might have customers, they have suppliers, they have employees, they have local communities, they have workers in the value chain, they have the environment, and they have a whole load of people that make up their cohort of stakeholders. Well, impact materiality then asks the preparer to consider, well, what ESG impacts does this company have on our stakeholders, and which of those are material? So an example here might be something like pollution. So a company might have a factory in a region. It might be maybe polluting the water or polluting the air. There mightn't necessarily be a significant financial cost to that, but there's obviously a local community affected. There's you know, there's the local environment and all those factors. So it might be considered to be material from an impact perspective for those reasons. When we consider impact materiality, there's a few areas that need to be considered. So things like actual and potential impacts, and the likely that potential impacts will become actual impacts, short, medium, and long-term impacts, positive and negative impacts, as well as the overall severity of the impacts themselves. So double materiality sets the reporting boundary for the sustainability statement, or it helps set the reporting boundary. And if something is material, either from a financial perspective or from an impact perspective or from both perspectives, then there's related disclosure requirements that are required to be made in that company's sustainability statement. So that's a very brief introduction into the concept of double materiality. It's definitely a topic worth keeping an eye on, because I know a lot of people on the call here today, it's certainly not something that's going to be crossing your desks today, but certainly as time goes by, even as into 2025, as large companies start becoming on stream, it's something that will become a little bit more prominent. So then on the next slide, then I'm just going to look at value chain and just how that forms part of the reporting standards under the CSRD. So I guess the best place to start here is to look and pose the question, well, what is a value chain? And a value chain includes the various activities, resources, relationships that a company uses and relies on to create its products, services, or whatever they're making, from conception to delivery. So as you can imagine, it's quite a wide chain. And there's three general terms that are used to define a value chain. So we've our upstream activities, or our upstream value chain, and that's our pre-production activities, what happens before the product reaches us. So typically involves our suppliers. We've got our own operations, which will be our own entity, or our own group, or whatever we're doing as a business unit. And then our downstream value chain. So what are when our product leaves and goes to its distributors and customers. So when we look at reporting under the ESRS standards, an entity needs to consider not just what its own operations are doing, or what's happening in its own operations, but what also is happening in its upstream and downstream value chain. And the reasons why value chain is a part of the ESRS standards is because an entity in its own right might consider itself to be very strong from an ESG point of view, but in its extended value chain, there might be some suppliers who maybe have poor ESG credentials, and it's only really through considering the activity in the entire value chain that a true sustainability picture will be obtained. So when preparing the sustainability statement under the CSRD, an entity is then required to include information about all the material impacts, risks, and opportunities, including those that arise in the upstream and downstream value chain. And it's also worth noting too that that value chain information isn't required for all information. So EFRAG at the moment are working on implementation guidance just to help preparers to see, well, how do we engage, or what is a value chain, and what necessary information do we need to disclose. So again, just to finish with, I guess, a word for SMEs. I guess many SMEs will look at the CSRD and look at the ESRS standards and see, well, okay, well, we're exempt from directly reporting under those standards. I suppose they might then conclude, well, there's nothing in it for us, or there's nothing that we need to be aware of. But many SMEs will be brought into the remit of the CSRD and the ESRS indirectly, because they might be a party in a supply chain for a reporter. So it's just something just to be aware of, that even if they're not in scope for reporting, they might be brought into scope by virtue of being part of a larger supply chain. So on our final slide, which I'll not dwell on because I'm just looking at the time here, and I know we're gone well beyond the target finish time. We just have a few resources here that hopefully you might find beneficial, and there's a couple of our own internal resources. We did a technical alert last year. We have a couple of LinkedIn newsletters, technical roundup, and the sustainability bulletin that Susan's also mentioned. So if you want to keep up to date on the various updates from a sustainability point of view, hopefully you might like to subscribe to those. So that's all from me. Back to yourself, Jeremy.
Listen, thanks, Dee, Susan, and Mike. You gave a great overview, setting the scene of where we're at with sustainability, and what's coming down the tracks in the next couple of years. You have some great resources there as well, and hopefully the three of you will be able to say, I think we might have a couple of questions coming in there, and we might catch up with you as well in 15 or 20 minutes or so as we come towards the end of the webinar, if there's any further points. Susan mentioned we have some upcoming CPD classes. We have an ESG workshop. If you want to learn a little bit more, it's a half-a-day workshop. Susan and myself and some other speakers will be taking part, so we get a bit more in-depth into ESG on the 18th of April. And if you want to learn and dive into the diplomas, the 2 diplomas we have in this area, that virtual open day that Susan mentioned, you can come along next Wednesday afternoon, free for an hour at 12 o'clock. Right, listen to our next segment, and I'm delighted to be joined by Neil Morrison and as well my colleagues Conal and Maria. Neil, hopefully you can hear and see us there. I know I've been in touch with you by message here, so I know you're a little bit time constrained, and my apologies, everybody, we are running a little bit behind.
No problem at all, Jeremy. Yeah, I can see. Hopefully you can hear me there now.
Brilliant, brilliant, brilliant. What I'll say, actually, firstly, I know myself and Conal and Maria, we're going to have a little quick chat beforehand. I think you have to be gone away by 12 o'clock or so, do you? Or how are you time-wise?
I'm tight enough, yeah. Apologies, Jeremy.
That's okay. Listen, let's have a chat. We can,
Sure.
as I say, we'll have our chat first, and then we can talk about the article as well afterwards. Then, as I say to you, listen, Neil, I know I set the scene at the very start, giving a little bit of an overview of your firm, established about 40 years, 50 staff, 6 partners in Swords in Dublin. I'm sure many would know your firm and would have heard in the media about your takeover by Danes Group. Tell us a little bit more about yourself, your firm, and I suppose how this came about, the actual approach, I take it, from one party or the other for the investment.
No problem at all. Thanks, Jeremy. Thanks for the invite to come on this morning and speak. Yeah, good afternoon, everyone. My own background is I'm a chartered accountant, chartered tax advisor, and also hold a diploma in solvency and corporate finance from Chartered Accountants Ireland. So I'm an advisory partner, Mark Saunders. I'm known as Jack of all trades and master of none. I know my partners call me something different, but I won't disclose that to you just yet. We are now a 6-partner firm, and we exited our 2 founding partners, Carl Saunders and Jeremy McInerney, about 5 or 6 years ago. 2 of my fellow partners, Owen and Susan, trained the firm, and then myself, Donna, and John joined me outside. And in December, we appointed Deirdre McGinley, who was audit director, as audit partner. So as a firm, we've always provided full service lines: audit, accounts, tax, bookkeeping, payroll is a big element of our business as well, which people may not be aware of, financial planning, corporate finance, and restructuring. So up to last year, our turnover was close to 6 million with 55 people. Some key things, this is pretty relevant to the Danes transaction. We were always part of a UK group called UK 200 Group, which is a group of independent accounting and law firms, and Danes were also a member of UK 200. Since October, 12 months ago, we're also part of Praxity Alliance, which is a global alliance of independent accounting firms. So historically, we've been top 20, pre-recession, probably around after recession, discussions of how to grow ourselves as a top 20 firm, where to go next. Are we going to have to bring in people on HR, BD, develop new service lines? And we previously acquired some small firms that just gave us more range of scope. So we've had those discussions, wondered where to go next, which I'm sure a lot of delegates have had the same conversations. And in 2019, personally, I kind of decided as a game plan, I wanted to give this 10 years max, and made that announcement at a partner meeting one Thursday afternoon to silence around the table. After going around the room, everyone said, I want out then as well. So as a partner team, we have a mix in ages with only a 10-year age gap from oldest to youngest. So it was something we'd never discussed before, never brought the thorny issue out on the table. And from that afternoon, we decided, okay, we continue on, hold back some reserves each year from our profits. And in 10 years' time, there's a war chest there to just, when we went to leave, we had some money to take off the table. And that was what started the process. Around the same time, the first consolidator was at play called Zenodin, who we were involved with. And that set the scene for a lot of, I think, firms in Ireland to say of the art of the possible, and is amalgamation possible, what's going to happen, and where's it going to go next. So that was really the background as to where we got to. When it moved from, we then had, I think, I can't remember, was it 7 or 8 approaches. And I'd expect an awful lot of practitioners on the call today have had emails, have had calls, have had a knowledge of what's going on, or an awareness of what's going on in the market. And it's really down to decisions of where people want to go. I think, as you alluded to remain independent, to sell part of your business, to collaborate, to grow, and there's plenty of options out there. So when we looked at it and we met various different people who were in the market, we'll be aware of a lot of what's there, and the great options for people that come to the end of this. So we decided that through Danes effectively to team up with a PE firm. So Danes are backed by a private equity house called Horizon Capital. And some people ask me why PE, and you know, fear of PE, and PE is into build, grow, get out, and is it mercenary? What happens next? So our idea of moving to a PE firm was really that historically practice have moved from the old partnership type model more to a corporate structure. So we're a corporate structure, but it's now more the model of running a corporate business. So not a buy-in from partners coming in, not someone going to write a check to fund our exits or to fund something else. So for next generation, I think there's so many options out there, and everyone knows so few people in practice when they stay in practice. You don't want to put barriers to entry of people to remain to become a partner. So we took the view that the model needs to change, and for future partners, they need to be part of a business, whether a partner in the business, they have a good salary in the business, they have some bonus or profit share pool in the business, and that was really the driving force behind why private equity. Second part of that, and without the requirement to buy into fund exits, for people looking to exit, it's a personal decision as to, am I going to exit shortly, medium term, long term? And with a private equity firm, you have options for equity roll-up. So for people of a younger generation who want to get out, they can stay and play. And if you want to stay with it, you can stay on a future exit, have effectively a second bite of the cherry. What we'd also seen from private equity firms, and probably no different to us, that the professionalism they bring is very, very different. So the corporate model of the oversight and what's put in place and intellect and insights that they offer. And even within Danes, so they're only, I was going to say 2 years now in with Horizon, and in the last 12 months, they've put in a full new C-suite. So recruit new CFO, COO, CTO, and the benefit and experience you get from bringing people outside our industry into our industry has been brilliant. So that was why PE, and then why Danes. And a key piece I alluded to earlier was being part of the UK 200 group. So this independent association of firms, we are all close to. We would regularly get an awful lot of work as an Irish firm from UK firms. But over the years, UK firms shared a lot of information with us because we don't compete. So we always learned what happened first in the US, then happened in the UK, then trickled across to us. So private equity has been around a long time in the US, only recent in UK, and we would have had a large awareness of what was happening in the UK. And we'd always collaborate with Danes as a firm. So we had the knowledge of the firm, knowledge of the people. And back in, I can't remember what year it was, around recession, we did a joint venture with 3 UK 200 firms that got us on the NAMA panel on a NAMA tender. So we did a tender to say we'd cover UK and Ireland, and Danes are one of the firms who were involved in that. And we've also worked very closely with them around customs, and John, my tax partners, worked with the VAT and Customs partner in Danes on customs and duty. So we knew them well, so had that people fit first. And you know, I wrote down 3 things as to why Danes, and the 3 words were culture, culture, and culture. And no different to when I'm acting for a client in a corporate finance mandate in a buy and sell. If you can't get on with each other, it doesn't matter what's involved, it doesn't matter what the offer is, what the deal is, it's not going to work. So, you know, when you're getting into bed with someone, being able to test the water, see what they're like, know you can work together, respect each other, have the same values, same ethos, it makes a huge, huge difference. And I think the word, and again, part of the industry has said, there's a lot of consolidators. I don't know if that's correct. I'd more call it collaborators. So, you know, we're trying to collaborate with firms, with ourselves, with other firms coming on board, so long as they're like-minded, culturally aligned businesses. And the article on our transaction was in the Irish Times on the Wednesday we came back after Christmas. And that week, I had 4 or 5 calls from practitioners who would know us to say, what's going on? Tell us about it. Can we have a chat? So there's an awful lot of interest in what's happening. Again, and part of what we saw with Horizon, by default, rather than by desire, they put in a chairman who's a guy called Neil Cox, and we met them as part of our due diligence process. Very, very good guy. And he had experience in the Irish market of building Aricus, which we know from our PI brokers as an insurance consolidator, player, or collaborator. So it was good to have that. The flexibility you get with doing a transaction with PE is excellent. It's no one size fits all. It's no, here's the deal. It's individual deals for each. And the one thing I'd say on learnings is that the needs of each individual are different. As 5 partners, we started the process, and I said to each of my partners, if one person doesn't want to transact, we won't do the deal. So whether you have 2 partners, 3 partners, 4 partners, there needs to be that alignment that, yes, we need to do this and move forward, or don't. And that, I'd say, was a key learning. Second question on that is whether to de-risk or not. So does someone want to effectively take cash off the table early days, or do they want to stay committed with the view of having a future return, no different to owning part of the practice going forward? And that staying on or timing of leaving is a big question. Still today, I would say that my biggest asset, or all of our biggest assets, is not our ownership of a firm, it's the ability to earn a living. So all someone is doing or transacting in any kind of sale in any business is, and anyone who's involved corporate finance would know, you're just capitalizing your future profits. So if someone's at an age profile of past 50 and has 10 years to go, yes, it's worth considering. If someone's at early 40s or earlier, it's a question, well, am I going to get value today or not? What are the opportunities there? And a couple of people I spoke to are of that age bracket. And we see as more people in that have built startup practices that are very, very good, and they're in it for the long haul. So already people are looking at who are the next successors 10, 15 years down the road, and where's the business going to be. The other main thing, and Jeremy, and I have to say, yourself and the engagement we got from the Institute was superb. And for anyone who's considering doing anything with their firms, whether it's just a restructure in general, so we hived out into another company, a professional services company. First conversation, I think Jeremy was with ourselves and Donna. You introduced us to Lisa, Alison and Aidan in professional standards. And the support we got from that was just phenomenal. And even at deadline days, it was brilliant. So I'm happy to share that guidance with anyone else who's looking at a restructure, even if they're not selling to anyone else. But I just say definitely speak to the Institute first. They've seen this happen, they know the process, and support has been superb. The other question you asked, Jeremy, was on deal learnings. And again, some of this is commonplace to every deal. And I spoke to a few clients and practitioners on this since, and I jokingly said, it's the hardest transaction I ever worked on for no fee. So if we were doing it for a client, it would be a great transaction. The timing and pace of due diligence is always an issue. And you know, when people expect, is it going to be a 6-month process? Allow it's at least a 6-month process, if not a 9 to 12-month process. But have your information ready early. And the one thing we learned, and this might sound a bit ridiculous from our background, was when private equity houses look at reporting, it's what they call LTM, last 12 months. So everything's reported on an LTM basis, not year end, not 6 months, not quarterly. And we learned a lot in that process of how we deal with our own clients. So you're learning as you go with what people look at. One that will be a bugbear, I'm sure most practitioners will say next, is WIP and debtors. Get your own house in order first. Clean up your balance sheet. So when it comes to looking at what your normalized working capital is, if you're carrying large lockup, effectively you're falling in your own sword. So if it's something you're considering, get your own house in order, because if you don't, it's going to cost you. Second on that, I'd say, and this is a learning we had in speaking to others who transacted with Danes, do your own due diligence, speak to others who've been through the process, speak to others who have either sold, or speak to other people who have sold to people you're speaking to. There's so many options out there today, it's unbelievable, and there's more and more coming. But you're better off having the cultural piece, and I would say, in general, a fast no is better than a slow no. If the fit is not there, decide very, very quickly the fit is not there. We had one meeting with one firm as part of our research, let's say, or negotiations, and there was a red line issue that came out on the table in the first 5 minutes, and was due a location. And the question was asked, would we move? And we're based in Swords, 10 minutes from the airport. Most of our team live close by. We will never move. And we said we will not move, and literally, book was closed. Well, we're not going to take an office in Swords. We want city centre location. So we said, no, thank you very much. And that was it. And yeah, that meeting was like an interview where you know someone's not going to get a job, and you're sitting for another 20 minutes just trying to play nice and be nice and done and dusted. So get the red line issues out and get them out early.
You've, Neil, give us some great food for thought there, some great insights into your practice, how you came into this process, And thank you as well for the compliment. And I would say to anybody as well with relation to any interactions, as you said, with professional standards, even changing a partner in a firm and so on, to contact our authorization team as soon as possible.
Yeah, I think in fairness, Jeremy, people have asked, what's it like? What's the new life like? So a lot of people asked me last night. I was at the RII dinner, and I don't mind sharing the independence piece, and to give up your independence is a definite one you've got to address. And personally, we completed on the Tuesday before Christmas. I can't remember what date it was. And on New Year's Day, I was sitting at home here and thinking, I'm going back now tomorrow like a child in a new school, a new headmaster. So what's the unknown, what to expect? And when we explained to our own team that, myself, Owen and Donna are still directors of the companies, we're still in control, we run the show, that bit of breathing space for them was great. So in a way, there's been no change. In other ways, really positive change. And the feedback we've got from our own team has been absolutely unbelievable. So people see an opportunity to be part of something bigger with now 650 people in the UK, opportunities for secondments, different service lines, moving in different areas where it's outsourced FD, forensics, get more involved in corporate finance. So yeah, it's really opened our eyes to the art of the possible.
I know, as I said to you as well, in our conversations, you're always happy to basically take calls or even meetings with anybody who's maybe thinking of this about for their own firm. As you said, it won't be for everybody, depending on your age and depending on the nature of your practice. But you're happy to talk to anybody.
Absolutely. I'm even speaking to someone at the minute who is not transacting with us, but transacting with someone else, just to give them the what to look out for. So I'm more than happy to speak to anyone at any stage. You can pass on my contact details, Jeremy.
Indeed, that link actually on the screen there, if you have the PDF of the slides, and we'll be sending out a new pack of slides with all the slides again with the webinar recording and so on. That link there takes us through to the McInerney Saunders website and all the details on Neil and the team. So you'll get the phone number and contacts there. I think at this stage now, and I'm not sure, Neil, can you stay with us for another couple of minutes?
Yeah, sure.
I'd be great to bring Maria and Conal back in. Hopefully you guys are both there. And of course, yes. the consolidation in the market, private equity investment, the route that Neil and his partners have taken has many advantages. But I suppose it's very important to think as well, and Neil talked about it there, it's not for everyone, depending on your age and what you're looking for in practice as well. And I know you and Maria have put together an article on that'll be in Practice Matters, which issues next week, just setting out the pros and cons with relation to your practice and the changing landscape.
Absolutely, Jeremy. Thank you very much. And Maria, you're very welcome back onto Practice News. Maria, we were talking, as we always do, what do we write in Practice Matters? And this came up. So what were the reasons that we came up with for writing about this?
Well, it was something that was really topical. It had been in the media, and we said we might as well take, whilst it's topical at the moment, we said we'd go and write it, because I think, and we always come back to it, but COVID-19 did make an impact on the environment that was there, and then all the new technologies that came led, to people starting to think, how can our business change? How can we provide a one-stop shop, as we called it in our article, to supply all these services, be it like cybersecurity, HR, pay, all different things. And so that's the main reason that we went about it, and we looked at it then, and we kind of took from the point of view of the advantages of staying within staying small, and then also the way of staying big or going into the market as a bigger player, if you want.
Absolutely. Yeah, absolutely. And I suppose we've looked at this. I suppose one question we just want to get out there first of all, because sometimes we are asked this, is does the Institute support independent practices, or is the Institute encouraging people to consolidate? And I think we can say that the Institute, first of all, strongly supports smaller practices, but equally supports you in no matter which route that you take. So I think if we look at our practices, we've got 1,600 practices, 1,200 in the Republic and 200 in Northern Ireland. But most of those are small, and most of those are independent. So we looked at the pros and cons, didn't we?
Just something that is touched on there, Conal, about the amount of practices we have, and we discussed this during the week, and we were saying that, we run 2 going into practice courses every year, and they are full. So a lot of people want to go it alone. So the Institute are fully behind people wanting to go it alone, or if they want to go down another route, we completely support them. So that's just something that I just wanted to touch on there.
Absolutely. It's all about you guys. It's all about what you want, I think. And one of the points there that you made in the article, Maria, was that for as long as there are small businesses who want to deal with the principal,
Exactly. Yeah.
Which isn't necessarily all small businesses, but many of them do value that personal interaction with someone who they know is the is in charge of their business. So like they I think, the feedback is that there's a continued role. Yeah.
Yeah, like many small businesses, like they will deal with entrepreneurs, they will deal with small businesses, and they enjoy having that relationship. So it is very important to kind of keep that. Certain staff as well, we have to be mindful that certain individuals are quite happy working in a smaller firm. They don't want to work in larger environments, and we just have to, and that is very, very important. And then, as well as that, we're kind of going down the route now here of our advantages of staying small. Some people don't like change. This is something that we have to be very mindful of. That their staff and their clients may prefer to be part of a smaller firm. And, that's there. And I know we spoke, with certain areas where you said that you've witnessed that where the deal was going down the line and then it just fell at the last minute because it was discommoding people and they weren't happy doing it, basically.
Yeah, absolutely.
Colin, from our point of view, and some of them questions or comments, Maria, as well, and I saw a question come up there in the chat box. Historically, we have bolted on a number of small practices over the years. And the one thing I explain to the guys in the UK, that's very different in the UK and Ireland, is relationships with clients in Ireland are personal.
Yeah.
They're personal to the individual. And this is where the culture piece comes, because if someone's transacting and they're selling a practice or a client base, they're going to be reliant on those clients remaining with the firm.
Yeah.
And the handover piece is key and integration is key. And historically, we have seen that, and we did one in September. So as part of our own due diligence going on in our transaction with Danes, we acquired a very good guy who was selling his practice at Malachy Stevens in Mullingar. And I'd known Malachy well from meeting him over the last number of years. He approached me, of course, I was interested in talking to anyone. And we transacted with him, took on his clients. One of his clients, and we sent the email out on the Monday announcing our transaction, rang me straight away and he says, I want an honest answer. Are you staying? I said, yes, I'm staying. He said, well, that's fine with me. So I think once that assurance is there, and this is the thing, well, yeah, it's not going to be lost. And part of the collaboration model, a lot of firms, a lot of acquirers are leaving the status quo. So, they'll have a firm in Dublin, acquire a firm in Cork, Limerick, wherever else, leave them running their own show, but integrate. Absolutely. So there's a mix of independence and collaboration. Others on a smaller scale will come and say, if there's a firm that we acquired, and I'll pick Carlo for argument's sake, and there was someone else in Kilkenny who could run that firm, we then merge those two businesses in that location.
It's all about culture. I think your point there resonated very strongly with me. And look, as I say, I'm delighted we were able to help you guys. I know Jeremy did most of the running there, and Aidan's team as well did most of the running. But look, yeah, absolutely, and I want to say that. But I say equally, one thing we were very keen to do in the article was to try and strike a balance and to make it clear that it is ultimately, and there's no one answer to this thing. There's no
absolutely.
There's as many answers as there are practices. Actually, that's something I could say here. Maria, I know you spoke in the article to Anthony Casey of Noon Casey. Many people will know Noon Casey. Firm, it's quite a well-known firm in South Dublin, and I think Anthony had there were certain parallels with Neil's story.
Listen to Neil speaking, yeah. Anthony's, their main thing was to get an international dimension to business, and that was that's where they wanted. That was where they were going down, and they had clients in certain sectors that kind of drove this because they felt they needed to get out there.
Yeah.
But they wanted to maintain, their main thing was to maintain their independence as well. So they were acquired by 51% by ETL. So it's a little bit different from Neil's story. So it's interesting to listen to both.
Yeah, I can tell you the difference is because we spoke to ETL as well, and Anthony at home well, and I think ETL solution is fabulous for a lot of practitioners. And ETL will acquire 51%, and it's only 51%. So if you have a two-partner firm and one wants to retire, they can sell one half to ETL, other partner remains in play and status quo. And what Anthony is building in Ireland is to replicate what they have in UK. So the service lines we have, where we have now our own talent acquisition guy who's working with us in UK, they have that in ETL, but trying to do it in Ireland as well. So as they build ETL, it's a great solution. The only downside we saw to ETL was the future buyout, future buy-in for partners, which is the underwrite again. So yeah, it depends on everyone's position. But the ETL model is great because if someone's retained their profit share going forward, they can sell part of the business and keep going as they are. And this is the thing, there's so many options out there and the models are changing every day. I came across two more entrants in the UK market only this week I never heard of. One big one called Summer, and they are funded by another private equity house, an ex-KPMG guys, and they acquired a 200 people firm on Monday or Tuesday. So there's different models for different scales, and that's going to definitely come over here very quickly.
Absolutely. But look, I mean, I think that's fascinating, Neil. It was also fascinating to speak to Anthony, and I think we'll certainly have to get him on in a future edition of Practice News. But I think we're well over time. Maria, I know you're just at the point of almost pressing that button.
No, not.
To get Practice News out the door. I think it'll probably be Monday. We'll probably just you and I have one last quick chat over it, and I think we'll get it out to people so they can read this article.
I thought you were saying press the button to leave. I
thought.
We're nearly there. We are nearly there. Hopefully Monday is like as you said, and then we should have it out fairly soon. Then fingers crossed.
Absolutely. People should look out for that.
Thanks again for the invite to speak. Much appreciated, and enjoy the weekend, folks.
Delighted, Neil. Delighted. All right.
Neil, thank you again. Yeah.
Not a worry. Take care.
Well, listen, and thanks, Maria, as well. Listen, Conal, you're right. We are well over time, and I know before we go to our UK tax update, I will just ask, I suppose, very quickly if Gearóid has any teams, if Gearóid is still with us, if you have any teams or anything that you want to add from the questions that have come into you to your tax update for Republic of Ireland, and then we'll go to Leoncha's recording, which is 12 or 13 minutes, and then we'll be finished.
Hey, Jeremy, yeah, still here anyway. Look, I've answered some of the questions there just directly. As I was just conscious, as always, as you said, we can't give advice, but obviously we can direct you. The first one there was just on the interest-free loans, and actually that was as I saw the question, it kind of reminded me I should have put a point in on that as well. So it's a good question. In relation to new mandatory reporting requirements of interest-free loans between close relatives for loans in excess of 335, will this be done on IT 38 for 2024? So it's not just loans in excess of the 335, it's just where the where there's a loan outstanding at the year end and the interest is the interest is either zero or below the prevailing interest rate for the ECB rate. The reportable gift is net of the small gift exemption, and I've just sent the link there into the revenue guidance as well on Revenue's website, which is where you'll find some useful examples there to follow. So if you are in the business of advising clients in the gift and capital acquisitions tax space, just jump into that link. It's there in the answered section of the question and answers, and that will give you a bit more information there. And as I say, the examples are useful. Also, just on the temporary mortgage interest tax credit and the Form 11, the Form 11 hasn't yet been updated, so we will keep you updated on that via Tax News. And just to let everyone know, and again, I should have included a point on this, Tax News is now available via LinkedIn. So if you keep an eye on the Chartered Accountants Ireland page on LinkedIn, so our profile on LinkedIn, you will be able to see tax news come out every Monday, and you can put in an alert, I think, so you could even get it on your phone. And I've looked at it myself, and I think it looks very sharp actually on LinkedIn, and it's a great way to get the news as well as get the usual updates on LinkedIn as well. And just a question there, I think, on the warehouse debt. Is it fair that warehouse debt has been reduced to 0%? It's a very fair point. look, I think it's a policy decision taken by the Department of Finance. So the reasons, I suppose, why they feel this is an appropriate step, like us, they're multifactorial with these things. And I suppose I don't have an insight into the policy decision behind it, other than, look, I know it is welcomed by certain advisors I'm speaking to around the country. But yeah, as to the point that non-warehouse debt will attract the usual rates of interest, I suppose that's the warehouse debt does come from a very unique time in the Irish economy. So obviously arising during the pandemic. So yeah, I suppose the policy behind it is exceptional. And I think there was another question just on the microgeneration for electricity, and I go back on that actually. But the typically these to the best of my knowledge are case for, but I would double check that. But as always, income would be returned on the Form 11 here. So general teams, yes. No general teams coming out. Actually, no questions in ERR following the presentation there. Now, I don't take silence as happiness or satisfaction with that requirement, but look, hopefully people are getting to grips with it to some extent, and look, we're continuing to engage with revenue on that, as I say. But other than that, we will see you again for the next round of practice news in a couple of weeks, and we'll have the latest.
Thank you again for giving that summary. To say to you, some very interesting questions there, and I'm sure they do relate to lots of our member practices. And yeah, great. We'll have you back on the 12th of April actually, so it'll roll around very quickly. And I know you're as I say, always dealing with members and so on as well, and offering what guidance you and the team as well. So listen, on that note, thanks again, Gerard. On that note, and I know we're a little bit a good bit later than planned. Delighted to have our UK tax update with Leoncha Doran. Chris in the background. Hopefully, Chris, you're able to get our recording up and going. And this is about 12-13 minutes, and basically, yes, I see something coming up here from Chris now. I think we will just go with that. Chris, are we just listen away? And it's always great to have Leoncha's UK updates. It's been a busy time with making tax digital. The income tax part of that is still rolling on, and of course here in Northern Ireland now with the reinstatement to the Assembly.
Hello, and you're all very welcome to my first UK tax update in 2024 for Practice News. I know that many of you with clients in the UK have been very busy in the last few months during busy tax filing season, so let's get going. Hopefully most of you know me by now, but for those that don't, I'm Leoncha Doran, the Institute's UK tax specialist, and I have nearly 30 years experience working in tax. I started as a trainee chartered accountant in what was then Coopers and Lybrand in their OMA office in September 1994. So the aim of this short recording, as you'll probably know from previous updates, is for me to provide you with a brief update on what's been happening since our last update in December 2023, and in particular what we as an institute have been working on for you, our members. So this time around, the key themes that I will be looking at are lobbying work, our work on EU exit, what's happened recently with the 2022-2023 self-assessment filing deadline, and then finally some miscellaneous areas of interest. So firstly, on lobbying work, I thought I'd look back over 2023 as a whole. So overall in 2023, the Institute, including the NI Tax Committee, made 11 formal submissions on a range of issues, many of which we highlighted to you during Practice News webinars last year. But we also lobbied informally UK government officials and HMRC on a range of other issues, including making tax digital, tax complexity, and HMRC service levels. Now, our lobbying work did result in a number of successful outputs, including a 1-year extension to the Trader Support Service and a 6-month extension to the VAT second-hand margin scheme deadline, with many affected businesses subsequently contacting us in the Institute to commend us for that success. We also continue to engage with UK government officials, including HMRC, by taking part in various regular HMRC stakeholder forums, such as the Representative Body Steering Group and the Making Tax Digital Advisory Forum. The Institute is also represented on a range of bespoke HMRC forums, including the R&D Tax Relief Subgroup Forum, the VAT Registration Forum, and the Wealthy External Forum. We're also represented at the UK Domestic Advisory Group meetings and the annual UK and EU Domestic Advisory Group and Civil Society Forum meetings. So overall in 2023, we attended well in excess of 60 meetings during the course of the year. Now, in terms of what we've done so far on lobbying for 2024, we made our first submission just days into January 2024 when we responded to HMRC's consultation on the amended MTD Making Tax Digital for income tax legislation. As part of that, we didn't solely look at the legislation, we took the opportunity to comment wider on our ongoing concerns in relation to MTD for income tax. And you can read our full consultation response on our website. Moving on now to EU exit. Our work on EU exit issues continues with the main body of work focused on the impact of the protocol, but in particular the Windsor Framework. Last year, we engaged with HMRC on numerous EU exit issues, including the VAT second-hand margin scheme, the new VAT-related payment scheme for second-hand cars, the lack of a reimbursement scheme, and the ongoing importance of a soft landing period to ensure any penalties are minimised for non-deliberate behaviour. We also helped the UK government by raising awareness of key developments and changes in legislation in relation to, for example, the Windsor Framework, VAT changes post-EU exit, and the Trader Support Service. And we did that by publishing information, guidance and bulletins for members. In addition, the long-awaited recommendation by the Institute of the need to open a reimbursement scheme came to fruition in June 2023 on the 30th of June. There was also engagement and continues to be engagement with government officials from the Department for the Economy, the Northern Ireland Office and the Foreign and Commonwealth Directorate Office. Overall, this work is particularly crucial in making sure that a number of important matters are clarified by UK government officials and HMRC in the context of the potential impact on Northern Ireland businesses and of course the wider Northern Ireland economy, particularly as a result of the Windsor Framework and other new legislation. And of course this work will continue in 2024. Coverage of guidance on the Windsor Framework and other key aspects is also included regularly in Chartered Accountants Tax News, and of course we welcome your feedback at any time on EU exit related issues, not just tax. In particular, we'd be keen to hear from you on the operation of the first phase of the Windsor Framework that commenced at the end of September 2023. So far in 2024, our work continues to focus on changes as a result of the Windsor Framework and things like the first stages of the UK's post-Brexit border controls that were introduced from the end of January. We would also like to remind you that traders should also be preparing to move export declarations from HMRC's chief system to the Customs Declaration Service by the 30th of March 2024, and that of course is just over 7 weeks away. And finally, we'll also be liaising with the UK government on what the changes to the Windsor Framework, which were announced last week and which resulted in the return of the Northern Ireland Assembly after 2 years, and specifically what these mean for traders. We'd also like to take this opportunity to remind you that the extended deadline for the end of the VAT margin scheme for second-hand vehicles, which were moved to Northern Ireland from Great Britain prior to the 1st of May 2023, was extended from the 31st of October 23 by 6 months to the 30th of April 24. That means that any vehicles sold after that date will be subject to VAT on the full selling price. In particular, if you have any clients who are affected by this deadline, please get in touch and let us know how this particular vehicle stock is moving. So moving on now to the 2022-3 self-assessment deadline. More recently, we know that many members have been working long and hard to file 2022-3 ASA returns by the 31st of January 24 deadline. Just to remind you that if you have any postmasters affected by the Horizon scandal, HMRC published guidance last month that confirms they will not be charged penalties for late filing if they didn't receive their top-up payment under the Horizon shortfall scheme, the compensation scheme, in enough time to file their return. Many of you will also be aware of the further restrictions introduced in December to the types of queries dealt with on the agent dedicated line and the self-assessment helplines in the run-up to 31 January. Last week, HMRC confirmed that it is continuing to offer web chat services for the agent dedicated line beyond 31 January for both self-assessment and pay-as-you-earn queries. So effectively, This appears to permanently change how HMRC handles some aging queries and follows on from recent restrictions at various times in 2023 introduced to the types of queries dealt with on these helplines. If members have any questions which haven't been addressed in HMRC's communications on this, or if they experience any problems with these further changes, please get in touch. Just note that as a result of these new restrictions, agents will be able to access web chat via HMRC's digital assistant without the need to speak to someone on the phone. However, if you have a complex or urgent query, you can still call the agent dedicated line by selecting option 1. For PAYE queries, the web chat service will focus on repayment queries and again can be accessed through the PAYE digital assistant. Again, you can call the agent dedicated line and speak to someone about PAYE queries by selecting option 2. And finally, we'd also like members who were involved in the recent deadline to get in touch with their feedback. We'd really like to specifically hear about your experiences in making contact with HMRC, particularly in light of these restrictions. We'll be accepting feedback until the end of this month via the contact details that I'll provide later. Moving on now to my last section here, and essentially there's a range of issues I want to cover in this part of my update. So firstly, just to remind you that as a result of the 2022-3 autumn statement, the rate of employee Class 1 national insurance contributions fell from 12% to 10% from the 6th of January 2024. Another change takes effect from the 16th of February 2024. HMRC has confirmed that it is removing the functionality that allows agents to copy existing authorised VAT clients across to their agent services account. Essentially, this means that from this date, agents who want to be authorised to represent their clients for VAT must do so in the agent services account using the process which is known as a digital handshake, i.e. clients must use the web link that agents send to them to complete this and authorise them for VAT. So I guess one of the key messages is to make sure that you've moved your already authorised VAT clients across to the agent services account before then. From the 26th of February, HMRC has confirmed that an agent reference number will be required on P87 employment expenses tax relief claims and on marriage allowance claim forms. If one is not provided, any repayment will be made to the taxpayer, even if it has been nominated to be paid to the agent. Now, the agent reference number is a unique identifier for each legal entity registered with HMRC as an agent, and previously it was used by HMRC mainly for internal purposes. But what we're told is that going forward, it will be used more frequently when agents contact or are dealing with HMRC. And finally, in terms of a simplification update that was published by the government last month in January, it was announced that from April 2026, the government will mandate the reporting and payment of income tax and Class 1A national insurance on benefits in kind via payroll software. Effectively, that will be the end of the annual P11D. Now, HMRC has said that it will engage with stakeholders to discuss this and to inform design and delivery decisions and produce guidance which it aims to make available in advance of 2026. But just to reflect on this, the timeline to move to mandation is short and doesn't provide much time to ensure that software is developed and tested before this significant change comes into place in 2026, when making tax digital for income tax is also scheduled to commence. Don't forget also that next month on Wednesday the 6th of March, it's the spring budget that will bring another Finance Act for 2024. Note that the most recent bill arising out of the 2023 autumn statement continues its progress through Parliament, but it was quite short. On Budget Day, we'll be issuing a special newsletter highlighting the key announcements to members, and we'll be following that up in the next Practice News webinar in April. And finally, just a reminder that this recording gives an overview only of what's been happening and key work streams. Remember, you can keep up to date with all the latest Irish, UK and international tax developments through Chartered Accountants Ireland's tax newsletter, which we issue every Monday. There's a link to subscribe to this on this particular slide if you haven't already done so. The final thing I want to sign off with is a thank you for listening and some contact details to get in touch if you have any questions or would like to provide feedback on any of the key areas mentioned. Thank you.
And thank you, Leontia, again for a very succinct and again detailed overview of what's been happening in UK tax affairs. Yeah, looking forward to having you back on again on the 12th of April. And of course, yeah, look out for the 2024 budget coming up on the 6th of March, and there will be updates from the Institute via email on that. Now, I know, Conal, we're coming to the end, and I know we have some further slides and upcoming courses and so on as well that you'll have in your pack. I won't bother showing them to you now, as I say to you, but it's been a very, I suppose, busy webinar. I'm not sure, have you any other questions, or maybe you have some thoughts, as I say to you now, as we come to the end of the session?
Absolutely. Well, I think most people are leaving, so I think we better wrap it up. One person says, what size level does a practice need to be before a PE firm would be interested in talking? So a practitioner here. Look, I don't know is the answer to that, because we haven't approached them as such in that sense. We've talked to firms who have talked to PE providers, but we haven't talked to the PE providers themselves. Haven't reached out in that process. I don't know if you have an insight into that, Jeremy. If you've done
I don't. I think it would be good, perhaps, and I'm sure Anthony Casey would do the same. I'm sure that actually with Neil, he's offered that if anybody is thinking about their future, looking at this as an option for a firm, no obligation, but happy to have a chat, and he'd give you insights because obviously from our conversation, you know that Neil has looked at all the options there, him and his partners, dealt and spoken to a number of the outside investors coming into Ireland in this regard. So yeah, best to get their insights, and as you know from Neil, speaks very candidly, very open, and will give you the straight answer. That's to the best of his knowledge there.
Absolutely, that's fine. Somebody else says. And we'll just finish with this one. Suggest increasing the CPD for this call from 2 hours to 2.5 hours to account for the extensive content delivered. Well, we certainly deliver a lot of content. And look, I mean, we've run over time. That was not in the plan, but we've done it. So apologies for that. But what I would say there is that CPD is self-assessed. If you spend 2.5 hours, you spend 2.5 hours doing structured CPD, which is what this is. So yeah, by all means, you can claim it. It'll be evident when we send out the recording that it was 2.5 hours long, so you'll have your proof of that if they were called upon. So, yeah, absolutely. I think that's a fair point. But as always, we'll endeavour to keep time better in future. Apologies, and I think, as I say, I think that's our cue to wind it up.
It is indeed. Just to thank everyone who took part today. Steve, Mike, Susan, Gerard, Leontia. I'm leaving somebody out here as well. Neil, of course, as I say to you.
Maria.
And Maria. And listen, guys, thank everybody. Chris and our CPD team in the background as well, and Paul and everyone else who helped us on this.
So listen, guys, thank you very, very much to everybody, and to yourself, of course, Jeremy. As always, I know you were particularly stressed with this particular one. Before us, you would never think that to see your delivery. So there we go. It's good. It's great to reach so many people. 600 plus bookings. It's absolutely incredible. And I think most of those people turned up on the day. So it's wonderful to hear from you all and to reach out. Okay, guys. Listen, if you're, I just wish you all the best. We'll see you again pretty soon. We've got a webinar coming up on
next Thursday. And if you look at the schedule, we've another one on the following Thursday on UK accounts, anti-money laundering in March. And don't forget, going into practice, if you're at that stage and thinking about it, or you have somebody you know that's on the 22nd of March, you'll be getting emails from us anyway on that.
Absolutely. I know the Leinster Society have an event about practice. If you're just thinking about it, they have an event. I think Eamon Lee is going to talk on it.
Yes, it's a little taster event on the 13th of March, and it doesn't negate your need to do your going into practice course either, but it gives you a taster maybe if you're actually just thinking, is practice for me? Eamon's a very accomplished practitioner, recently retired, and always gives a great overview of I suppose just the key things to think about in running a practice. So that'll be a great webinar for anyone. It's on the 13th.
Perfect. Great. Until then, look after yourselves. Cheers now.
Bye-bye, guys.